One of the key findings of the SREP was that 6 banks have failed your capital requirements. So perhaps the key question is, why was that, or was it very individual?
Well, first of all, it is not correct that they failed the results. Some banks are below what we call the Pillar 2 guidance, so the buffers that we require them to have, but we already say that they would be free to dip into these buffers until the end of 2022. So actually the situation is as expected, and the number of banks that are below the bar is lower than last year, and we expect also that 2 of these 6 banks will probably manage to, just go above the bar when the end-year results will be factored in. So the situation has been improving. It is not really an effect of the pandemic, having the banks going below the threshold that we set for them. It is more banks that have structural issues that are still grappling with, and they are gradually, let's say, recovering. So that's the situation.
Are they coming from from a regional, or is there a regional focus? I know you don't want to say which banks it is, but do we have an understanding of where they are coming from? Is it more the periphery, or is it core, or is it widespread?
Well, in terms of the transparency, let's say, we are publishing actually the Pillar 2 requirements for all the banks. They are on our website today. What we don't publish is the so-called buffers, but as I said, we made the use of these buffers available for banks. Of course, as I mentioned, the banks which have struggled a bit still to recover and rebuild their buffers are those which were saddled with legacy assets from the past crisis, from the sovereign debt crisis and from the great financial crisis. So it's still banks that are still struggling with non-performing assets, most of them.
One of the striking issues, I would say, going through the pandemic, everybody was thinking that there will be huge amounts of non-performing loans coming up, but they have not. So what's the reason for that? How can you explain that?
Well, first of all, the extraordinary support measures that have been deployed by governments have helped a lot, because the support was given to households, small and medium businesses, corporates. So these, of course, improve their ability to repay the banks. But I must also praise banks themselves. I must say that banks that had, for instance, a rather heavy legacy of non-performing loans have continued cleaning their balance sheets also throughout this period. There have been good market conditions with investors searching for yield, and they've been able to sell or securitize these assets and to continue cleaning their balance sheets. So the non-performing loans have actually declined unexpectedly, I must say. I was expecting last year, as you did, probably an increase in non-performing loans, so it's very positive to see that there has been progress in this area. Of course, we should not lower the guard now. The pandemic is not over. There are sectors which have been heavily hit by the crisis, and when the final support measures will be withdrawn, we can still have, asset quality problems materializing. That's why we are asking the banks to focus very much and strengthen their credit risk controls.
Yeah, that would be my next question, whether you think that it's not the worst is yet to come, but whether we still can have an uptick in non-performing loans, especially from the service sector, because in countries like Germany, for example, there is still at least a partial lockdown in place.
If you look at the expectations of the banks and their provisioning decisions, they definitely seem to think that the worst is behind our back, so that the situation has improved and that the quality of their borrowers is pretty good. Still, as I mentioned also in presenting the findings of our annual review, many banks have had some significant shortcomings in their credit risk controls, in the way in which they measure credit risk. So first of all, we ask them to strengthen their way in which they measure, to take action early, to assess when there is an unlikeliness to pay of their customers, and indeed maybe to focus more on some of the sectors which have been hit the most by the crisis, so the accommodation and food services sector, travel, but also commercial real estate, for instance, which is a sector on which we are doing a specific deep dive right now.